What if I told you you could turn a single snowflake into a mighty avalanche? That's right, we're talking about the kind of growth that can turn your financial dreams into a reality. Hey there, welcome back to Fun Financial Insights, where we make money matters both fun and insightful. Today, we're diving into a topic that's hotter than the latest tech trend. It's all about dividends. We're going to unravel the secrets of the SCHD, that's the Schwab U.S. Dividend Equity ETF for those new to the game. We'll explore how this financial snowball can grow from a gentle flurry into a dividend-delivering powerhouse, providing you with a stream of massive income that could just see you through retirement and beyond. Whether you're a seasoned investor or just starting out, you're in for a treat, because here, we don't just tell you about money, we show you how to make it work for you. So what is SCHD? Well, now we're zooming in on the Schwab U.S. Dividend Equity ETF, better known as SCHD. This powerhouse ETF is not just any fund. It's a vehicle designed for those who appreciate the value of dividends and the companies that consistently pay them. SCHD tracks the Dow Jones U.S. Dividend 100 Index, a collection of 100 high-yielding U.S. stocks known for their dividend reliability and strength. These aren't just any companies, they're the cream of the crop, selected for their financial health and ability to sustain and grow dividends over time. With a total net asset value soaring over $54 billion, SCHD is a titan in the ETF world. It boasts a low expense ratio of just 0.06%, making it a cost-effective choice for investors. But what truly sets SCHD apart is its focus on quality and sustainability. The ETF invests in stocks that exhibit fundamental strength relative to their peers, based on financial ratios like return on equity, which stands at an impressive 28.87%. The fund's performance speaks for itself. With a price-to-earnings ratio of 15.92 and a price-to-cash flow of 9.46, SCHD offers a balanced approach to dividend investing. Its SEC yield of 3.81% and distribution yield of 3.30% are testaments to its ability to provide investors with a steady stream of income. But SCHD isn't just about the numbers, it's about the strategy. By focusing on companies with a history of consistent dividend payments and fundamental strength, SCHD positions itself as a cornerstone in any dividend investor's portfolio. It's a commitment to quality, stability, and growth. So, when you think of SCHD, think of it as your financial guard dog, fiercely protecting and growing your hard-earned money with the power of dividends. So what's the big deal about dividends anyway? Well, let's crunch some numbers and sprinkle in some historical data to find out. Dividends are your share of a company's profits, and they've been sweetening investor returns for over a century. Did you know that since 1930, dividends have contributed approximately 40% to the total return of the S&P 500? That's right, nearly half of the long-term returns from one of the world's most famous indexes come from dividends. But wait, there's more. Companies that grow their dividends have historically outperformed those that don't. From 1972 through 2017, stocks that are initiated or grew their dividends delivered an average annual return of 10.07%, while non-dividend paying stocks only managed a meager 4.23%. That's a staggering difference that can make or break your retirement plans. Now, let's get interactive. Imagine you invested $10,000 in a portfolio of dividend aristocrats, companies that have increased their dividends for at least 25 consecutive years, with an average yield of 2.5% and dividend growth of 5% per year. Your annual income from dividends would grow from $250 to nearly $700 in 20 years without lifting a finger. And if you reinvest those dividends, well, your $10,000 could balloon to over $40,000. But dividends aren't just about the past, they're a beacon for the future. In times of market turbulence, dividends can provide a buffer. Even during the dot-com bubble and the 2008 financial crisis, companies with a strong dividend history held their ground much better than those without. Now, let's look at the numbers that make SCHD a standout ETF in the dividend domain. Let's start with the recent performance saga. In the trailing year up to May 2024, SCHD has delivered a solid 14.28% return. But that's not a surprise or a one-hit wonder. Over the past decade, SCHD has consistently outpaced the large value category average, with a 10-year return of 10.90%. That's the kind of performance that can turn heads in portfolios in the right direction. But how does SCHD do it? Well, it's all about the selection criteria. SCHD targets companies that are not only dividend payers, but also dividend growers. These are the financial Olympians, the companies that have the strength to increase their dividends year after year. And with a yield of 3.47% as of May 2024, SCHD is serving up a dividend feast. Now let's zoom in on the numbers. SCHD's portfolio turnover rate stands at 29.52%, indicating a focus on long-term holdings. Its price-to-earnings ratio is a reasonable 15.92, and the price-to-cash flow is an attractive 9.462. These numbers are music to the ears of value investors looking for sustainable income. But wait, there's more. SCHD's weighted average market capitalization is a hefty $121.02 billion, showcasing its tilt towards large, established companies with a track record of financial stability. And with a return on equity of 28.87%, SCHD's holdings are not just surviving, they're thriving. Picture a tiny snowball perched atop a snowy hill. With a gentle push, it starts rolling down, picking up more snow and momentum with each turn. This is the essence of the snowball effect in dividends. When you reinvest your dividends to purchase more shares, these additional shares then generate their own dividends, leading to exponential portfolio growth over time. Let's bring in some real-world numbers to see this effect in action. Imagine you start with an investment that pays a modest dividend yield of 3%. If you reinvest those dividends, not spending a single dime, and the company increases its dividends by 6% annually, here's what happens. In 10 years, your yield on the original investment nearly doubles. In 20 years, it quadruples. But how significant can this growth be? According to a study by Hartford Funds, a whopping 78% of the total returns of the S&P 500 from 1970 through 2018 can be attributed to reinvested dividends and the compounding returns they generated. That's right, nearly 4/5 of the growth came from this snowballing effect. Interactive moment, let's say you're building a snowman, but instead of snow, you're using dividends. Each year, the snowman gets bigger as you add more dividend snow to it. Now, replace the snowman with your investment portfolio and watch as it grows larger and more robust with each passing year, all thanks to the power of reinvested dividends. This snowball effect is a proven strategy for building wealth. By focusing on dividend growth stocks, such as those from the dividend aristocrats or dividend kings, you're setting yourself up for success. These companies have not only paid dividends, but have raised them for at least 25 to 50 consecutive years, respectively. Hey, if you're loving this deep dive into the dollars and cents of dividends, smash that like button and subscribe to Fun Financial Insights for more wealth-building wisdom. Don't forget to hit that bell icon to get notified about our upcoming episodes. Now, there's more in the upcoming segments. We're going to reveal how to construct a dividend portfolio that's not just good, but great. We'll also share top strategies to maximize your dividends and unveil the secrets to living off dividends in style. So stay tuned because you won't want to miss the golden nuggets we have in store for you. Diversification is key. You wouldn't build an igloo with snow from just one spot. You need a mix to make it strong. Similarly, your portfolio should include a variety of dividend-paying stocks from different sectors. This way, if one sector melts a bit under the market heat, your portfolio doesn't turn into a puddle. When selecting stocks, think of them as the bricks of your igloo. You want sturdy, reliable ones, right? Look for companies with a history of paying consistent dividends and the potential for growth. These are your blue chip stocks, the ones that have stood the test of market blizzards. Now let's bind these bricks together with the mortar of reinvestment. By enrolling in a dividend reinvestment plan, DRIP, you automatically reinvest your dividends into purchasing more shares. It's like using the snow that falls off your igloo to make it even bigger. Now, historically, a well-diversified dividend portfolio has provided investors with a steady income stream and capital appreciation. For instance, the S&P 500, which SCHD aims to outperform, has delivered an average annual return of around 10% over the last century, with dividends reinvested. How much SCHD should you shovel into your portfolio? Well, that depends on your risk tolerance and investment horizon. A young investor might allocate a smaller portion to SCHD and more to growth stocks, while someone closer to retirement might do the opposite. It's all about balancing the snow load to keep your igloo intact. Risks like inflation and market volatility are the avalanches and thaws of our metaphor. To manage these, consider bonds and other income-generating assets to insulate your portfolio. Dividend Reinvestment Plan, or DRIP. Now, let's discuss some strategies for maximizing your dividends. Dividend Reinvestment Plan, or DRIP. DRIPs turn your dividends into more shares automatically. No effort, no fuss, just pure compounding magic. For example, if you had invested $10,000 in SCHD 10 years ago and reinvested all dividends, your investment would now be worth approximately $46,000. Qualified dividends. Let's talk taxes. Not the most exciting topic, but knowing the strategy of qualified dividends can turn leaden tax bills into golden savings. Qualified dividends are taxed at a lower rate, meaning more money stays in your pocket. For instance, if you're in the 35% tax bracket, a non-qualified dividend gets taxed at that rate. But a qualified dividend, that's taxed at just 15%. Yield versus growth. High-yield stocks might seem attractive, but they can be risky. Instead, balance your portfolio with a mix of high-yield and growth stocks. This way, you're not just collecting dividends, you're also investing in companies with potential for capital appreciation. By wielding the DRIP wand, mastering the use of qualified dividends, balancing yield and growth, diversifying across sectors, and navigating the tax labyrinth, you can turn your dividend stream into a waterfall of wealth. Challenges and considerations. Dividend investing isn't always smooth sailing. Market volatility can rock your boat, and dividend cuts can feel like a rogue wave crashing over your plans. But fear not. For every challenge, there's a strategy to keep you afloat. Market fluctuations are as certain as the tides. A study by Hartford Funds showed that from 1940 to 2023, dividends contributed an average of 34% to the total return of the S&P 500 index. But in stormy market conditions, dividends can be reduced or even suspended. It's crucial to have a diversified portfolio, not just in SCHD, but across various sectors and dividend safety ratings. And then there's inflation, the silent thief in the night. Over time, it can erode the purchasing power of your dividends. The key is to focus on companies with a history of dividend growth that outpaces inflation, ensuring your income stream maintains its strength over the years. Dividend investing requires discipline, patience, and a long-term view. It's about building a lighthouse of solid stocks that can guide you through the fog of market uncertainty. Well, it's been a ride full of insights, and I hope you're leaving with a backpack full of strategies. Remember, building a life on dividends is like planting a garden. It takes time, care, and a bit of weathering through storms. But with patience and persistence, you can harvest a bounty that sustains you through all the seasons. Hey, if you enjoyed this episode, don't forget to like and subscribe to Fun Financial Insights. Share this episode with your fellow investors, friends, and anyone who dreams of living off their investments. Keep investing, keep learning, and keep dreaming. Because in the world of finance, the more you know, the more you grow. This is Fun Financial Insights.